There's a dangerous and costly lie at the heart of the reverse mortgage industry. It's a single, profitable misconception that banks are quietly counting on you to believe. This isn't some small misunderstanding. It's costing retirees just like you thousands, sometimes hundreds of thousands, of dollars in lost home equity. It's creating a level of fear and confusion that's entirely preventable. They've built a business model on your uncertainty, and it's a strategy that preys on the very people this financial tool was supposed to help. I've been in finance for 25 years. I've seen the tricks and I've seen the traps. I know how big institutions frame conversations to their advantage. So today, we're pulling back the curtain. I'm going to show you what the banks and those slick TV commercials conveniently leave out. We're going to talk about the new rules for 2026 that are changing everything. Rules you absolutely have to understand before it's too late. These changes can be your shield or the weapon used against you. The first thing to know is that the whole story you've been sold is built on fear, and we're going to dismantle it piece by piece, starting right now. Before we get to the myths, you need to really get how a reverse mortgage works, without the confusing jargon they hope you'll just skim. Forget the ads for a minute. At its heart, a reverse mortgage is just a loan. The most common type is a home equity conversion mortgage, HECM, which is insured by the FHA, the Federal Housing Administration. That government insurance is a huge piece of the puzzle, and we'll come back to it. Think of your home's equity as a savings account you've been paying into for decades. A reverse mortgage is just a way to make withdrawals from that account without having to sell your house. With a traditional mortgage, you pay the bank every month to build equity. With a reverse mortgage, the bank pays you, and your loan balance grows over time. So who qualifies? The rules are pretty simple. First, you have to be 62 or older. Some private jumbo reverse mortgages are out there for people 55 and up, but the federally insured HECM is the gold standard. Second, the home has to be your primary residence, where you live most of the year. This isn't for your vacation spot or a rental. Third, you need a good chunk of equity in your home, usually 50% or more. A lot of folks who qualify own their homes outright. If you do have a small mortgage left, the reverse mortgage pays that off first, and you get what's left. Finally, you have to go through a mandatory counseling session with a HUD approved counselor. This isn't a sales pitch, it's a government required reality check to make sure you know what you're getting into. So, how do you actually get the money? This is where the flexibility comes in, and it's something the ads often gloss over. You've got options. You can take a single lump sum. You can choose a 10-year plan for fixed monthly payments as long as you live in the home. You could get a term plan for monthly payments over a set number of years. Or, and this is often the most powerful choice, you can open a line of credit to draw from whenever you need it. The best part? The unused portion of that line of credit actually grows over time, giving you more borrowing power in the future. The loan only has to be paid back when a maturity event happens. That's when the last borrower sells the house, permanently moves out, or passes away. And permanently moves out is a key detail. If you're gone for more than 12 straight months, say in a long term care facility, the loan becomes due. And here's another critical point: these loans are non recourse. Banks don't shout this from the rooftops, but it's your single greatest protection. It just means that you, or your kids, will never owe more than the home is worth when the loan is due. If the housing market tanks and your loan balance is $300,000, but your home only sells for $250,000, the FHA insurance covers that $50,000 gap. Your kids aren't on the hook for a dime. This protection is absolute. So, the basics are: it's a loan for seniors 62 plus that turns home equity into cash with no monthly mortgage payments. You stay in your home, you decide how you get the money, and it's repaid when you leave the home for good. And you're protected from ever owing more than the home's value. Armed with those truths, let's get into the lies. Quick break. If you're finding this useful and you want more straightforward financial info, take a second to hit subscribe. It tells YouTube that people want honest content, and it means you won't miss what's next. Your support helps me fight the misinformation. This brings us to the core of the problem. The fear around reverse mortgages isn't an accident. It's fueled by old, persistent myths. Those myths create uncertainty, and when you're uncertain, you don't ask the right questions. Let's tackle the three biggest myths right now. Myth number one: the bank takes your house. This is the big one, the most damaging lie out there. It's the mental image of a greedy banker snatching the keys right out of your grandma's hand. And it is completely 100% false. Here's the truth: with a Heckham reverse mortgage, you keep the title. You still own your home, just like with a regular mortgage. The bank's name isn't on the deed. They don't co-own anything. They just place a lien on the property. The exact same thing that happens when you buy a house with a mortgage. A lien is just a legal claim to make sure they get paid back when the house is eventually sold. Think about it. When you bought your home, did the bank own it? No, you owned it. The bank just had a security interest. Same deal here. It's your home. You can paint the kitchen, plant a garden, do what you want. The lender's only right is to get paid back when the loan is over, when you sell, move, or pass away. This myth is so profitable because it scares off people who could really use the money. But it also means that if someone does get a reverse mortgage, they feel so grateful that they don't shop around for the best deal. Fear is a terrible negotiating tactic. So let's be crystal clear. The bank does not take your house. You are the owner, period. The only way to lose your home is foreclosure, and it's for the same reasons any homeowner would. You have to pay your property taxes, you have to pay your homeowner's insurance, and you have to maintain the property. If you stop paying property taxes, the county can foreclose on you, reverse mortgage or not. The loan agreement just holds you to the basic responsibilities of owning a home. Myth number two: my kids will be stuck with the debt. This is the second great fear, the one that hits right in the heart. No parent wants to leave their kids a financial mess. The ads dance around this, but they rarely explain it in plain English because the truth is actually very reassuring. Here's what really happens. When the last borrower leaves the home, your heirs are in the driver's seat. They get options and time, usually up to 6 months, with possible extensions up to a year, to decide what to do. First, they can keep the house. If it's the family home and they want it, they can pay off the reverse mortgage balance with their own money or by getting a new mortgage. The house is then theirs, free and clear. Second, the most common route is they can sell the home. They put it on the market, sell it for full value, and pay off the loan from the proceeds. Whatever money is left over, and in a market with rising home values, there's often a lot left over, is their inheritance. If the loan balance is $200,000 and they sell the house for $500,000, they walk away with $300,000. And that money is typically tax-free to them because of something called a stepped-up basis, where the home's cost basis for tax purposes is reset to its market value at the time of death. Third, what if the loan balance is more than the home's value? This is where that non-recourse feature is a superpower. Let's say the loan is $300,000, but the market tanked and the house sells for $250,000. Your heirs sell the home, the lender gets the $250,000, and the extra $50,000 of debt just disappears. Poof. It's covered by that FHA insurance you paid for. Your kids owe nothing. The lender can't touch their bank accounts, their cars, or anything else. In that scenario, the heirs have another choice. They can just hand the keys to the lender and walk away completely clean. It's called a deed in lieu of foreclosure. They lose the house, but they have zero financial liability. The choice is always theirs. So no, your children are not stuck with the debt. They are given options, time, and a powerful safety net. The only thing they lose is the portion of equity you used to live a better, more secure life in your retirement. Myth number three: it's free money with no downsides. On the flip side of the fear-mongering is the equally dangerous idea that a reverse mortgage is just free money. The commercials with smiling seniors on boats make it seem like a consequence-free cash machine. This is the other side of the lie. A reverse mortgage is a loan. Loans have costs. It's not free money, it's your money taken from your home's equity. And there are fees to do it. Let's break them down. First, upfront costs. There's an origination fee, which is what the lender charges to set up the loan. Then there are standard closing costs, like an appraisal and title search, just like any mortgage. The big one is the FHA Mortgage Insurance Premium, MIP. This is what pays for that non recourse protection. So while it's a cost, it's buying you that critical safety net. Second, ongoing costs. Every year, a smaller MIP gets added to your loan balance. And of course, there's interest. You can get a fixed rate, which usually requires taking a lump sum, or a variable rate, which is necessary for the line of credit. Since you aren't making monthly payments, this interest compounds, and your loan balance grows. That growing loan balance is the fundamental trade-off. You are exchanging future home equity for cash and security today. The funds are tax-free and don't mess with your Social Security or Medicare, but they are eating into your equity. It's not free. It's a strategic financial move. For someone who is house rich and cash poor and wants to stay in their home, it can be a brilliant trade. For someone who might move in a few years, the upfront costs could make it a very expensive choice. Anyone who says the costs are nothing to worry about is not your friend. Okay, let's talk about what's happening in 2026. The landscape is shifting, creating a unique window of opportunity and some new risks you have to know about. Urgency point 1: the spike in due and payable notices and new hurdles. For years, the main reason a reverse mortgage came due was the death of the borrower. Not anymore. We're now seeing a sharp increase in due and payable notices sent to living borrowers. This isn't some new trick. It's lenders getting much stricter about enforcing the existing rules, especially after all the COVID era leniency. Remember those obligations? Pay your property taxes, pay your homeowner's insurance, and maintain the home. That grace period is officially over. Lenders and HUD are using automated systems to crack down. If you miss a tax payment or let your insurance lapse, you'll get a default notice way faster than you would have a few years ago. They're also checking occupancy more rigorously. On top of that, as of January 5th, 2026, users of FHA systems must use new, phishing-resistant multi-factor authentication. This is a technical hurdle that can be frustrating and may complicate how you or your servicer access account information. What this means for you is simple. You need a bulletproof plan to cover your taxes and insurance for life, and be prepared for stricter administrative oversight. Ignoring this new reality is a fast track to trouble. Urgency point 2: the 2026 window of opportunity, high limits and shifting rates. While the new enforcement is a risk, there's a silver lining. First, the HECM lending limit has been increased again. For 2026, the FHA has raised the maximum claim amount to $1,249,125. This reflects today's high home values and means more potential cash for those in high-value homes. Second, interest rates. After a period of crazy hikes, variable rates have remained elevated, with recent data showing HECM adjustable rates in the 6 to 7% range, depending on the loan. The amount you can borrow is directly tied to the expected interest rate. Lower rates generally mean you can access more of your home's equity. This creates a unique moment. Home values are near record highs, the lending limit just went up, and rates are in a state of flux. Acting in this 2026 environment could mean locking in today's high home value at a more favorable borrowing calculation. But this window won't be open forever. Urgency point 3: critical updates for spouses and heirs. Finally, there are critical updates for spouses and your estate. First, spouse protections. For loans taken out after August 4th, 2014, protections are in place for a younger, non-borrowing spouse to stay in the home after the borrower passes. But for loans older than that, these protections weren't automatic, leading to heartbreaking situations. While HUD established a process in 2015 called the Mortgagee Optional Election, MOE, to offer some protection, the surest path is a modern loan. Refinancing an older reverse mortgage into a new 2026 loan could be the best way to add a spouse and get them full, modern protection. Second, a quick word for those of you with significant assets. The federal estate tax exemption rose to $15 million per person as of January 1st, 2026, meaning most estates won't face this tax. However, for those of you who might be near or above that level, this is still a planning conversation worth having with an estate attorney. Using reverse mortgage proceeds for strategic gifting, for example, can be a way to move wealth out of your taxable estate. It's a niche strategy, but for the right family, it's a powerful one. So, after all that, what's the verdict? Is a reverse mortgage a trap or a tool? The answer is it's both. It's a powerful tool for the right person in the right situation. A house rich, cash poor senior who wants to stay in their home long term and needs to supplement their retirement income. For that person, it can be a lifeline. But it's a trap for the wrong person. If you might move in a few years, the costs are too high. If you can't afford the taxes and insurance now, a loan that requires you to pay them could be a setup for failure. And if your number one goal is leaving the home to your kids totally debt free, this isn't for you. And keep an eye on the horizon. HUD is currently exploring major reforms to the HECM program based on feedback from the industry. Proposed changes like restructuring insurance premiums could make these loans cheaper and more flexible in the future, so it's a space worth watching. The choice is yours, but you have to make it with your eyes wide open. To protect yourself, here's your action plan. Before you sign anything, you must demand clear answers to these questions. Your action plan. The questions you must ask. Give me a complete, itemized breakdown of all costs on one page. I want to see the origination fee, closing costs, upfront MIP, annual MIP, and the interest rate. What is the interest rate? Is it fixed or variable? If it's variable, what is the absolute maximum it can reach? Show me a projection of my loan balance over time. How much will I owe in 5, 10, and 20 years? I'm going to have my kids on our next call, and I want you to explain the non-recourse feature to them. What specific things would cause this loan to default and be called due? If I have a non-borrowing spouse, show me in the loan documents exactly what protections they have. What happens if I have to move into a nursing home for more than a year? Explain the exact timeline and my family's options. Don't accept vague answers. Don't let them rush you. It's your home and your future. You're in charge. The verdict is clear. A reverse mortgage is not good or bad. It's a powerful and dangerous tool. What matters is who's wielding it. Today, you learned how to be the one in control. You can spot the lies, you understand the costs, and you know the new 2026 rules. But this is just one piece of your retirement puzzle. True financial security means having a complete plan. This isn't the time for guesswork. It's time for clarity. That's why the most important first step I can recommend is getting a crystal clear view of where you stand today. For just $27, you can get My Financial Picture, the same software I use to see my entire financial world on one screen: net worth, cash flow, debt, and investments. It's the starting point for every smart decision. I've also put links for our free mortgage calculators and some life insurance options in the description below, so you can explore all your options. And if you want to sit down with me directly to run through your specific situation, I do take a limited number of one-on-one sessions each month. The link for that is in the description as well. Don't let the bank's confusion be your strategy. Take control. Use these tools, own your financial future, and make the powerful choice, not the easy one.